Have you ever pondered how much your savings would have grown if you had invested in gold? Gold as an investment has a storied history that is as old as civilization itself. Revered for its beauty and rarity, it has been a symbol of wealth and power for millennia. But gold isn't just about ornamental value or historical significance. It's a tangible asset, a hedge against economic uncertainty. Imagine for a moment a sum of $100,000. Now, envision that same sum invested in gold back in 2020. Fast forward to today, and that investment would have seen significant growth. Gold's value doesn't just remain stable, it has a tendency to increase over time, especially during periods of economic instability. This isn't just a hypothetical scenario. It's a reality for many savvy investors who saw the potential in gold and capitalized on it. With that in mind, let's delve deeper into the actual numbers, shall we? Now, to appreciate the power of gold, we need to compare it with something we all use and understand, the US dollar. Over the last 2 decades, the buying power of the US dollar has faced a significant decline. Imagine you had $100,000 in the year 2004. Fast forward 20 years, and that same amount, without any investment or interest, has lost nearly half of its buying power due to inflation. On the flip side, let's consider gold. If you had invested that same $100,000 into gold in 2004, today you'd be sitting on a pot of gold worth nearly $500,000, a stark contrast to the dwindling value of the uninvested dollar. This comparison isn't just about numbers, it's about understanding the fundamental differences between these two forms of wealth. The US dollar, controlled by the Federal Reserve, is subject to government policies and inflation. Gold, however, is a tangible asset. Its value doesn't hinge on government decisions or the state of the economy. Over the years, gold has proven to be a steady, reliable store of value. It's not just a shiny metal, but a shield against economic uncertainty, a hedge against inflation, and a ticket to financial security. As you can see, the value of gold has generally outperformed the US dollar over the years. But what if you decided not to invest your $100,000 in gold and instead left it in the bank? Let's delve into that scenario. As the years pass, your money doesn't grow, it simply sits. Still sounds safe, right? But here's the kicker: inflation. It's a silent thief that erodes the value of your money over time. If we look back over the last 2 decades, the average annual inflation rate was about 2%. That means 20 years later, your $100,000 would only hold the buying power of roughly $67,000 today. That's a potential loss of $33,000. It's clear that leaving your money in the bank may not be the most profitable decision. Gold seems like a pretty good investment, doesn't it? But, as with any investment, there are pros and cons. Let's start with the bright side. Gold acts as a hedge against inflation and currency fluctuations, keeping its value over time. It's a tangible asset, something you can hold in your hand, and it's universally accepted. On the flip side, gold doesn't produce income like stocks or bonds. It has storage and insurance costs, and its price can be volatile. It's also subject to capital gains tax. So, while it can be a safe haven in turbulent times, it's not without its challenges. In conclusion, gold can be a valuable part of a diversified investment portfolio, but it's essential to consider all factors before making a decision.